So what is a passive investor and what is passive investment? What happens with a passive investor is they don't attempt to beat an index, but they simply try and track it by buying the underlying shares. So our index could be, for instance, the Johannesburg Stock Exchange, the Nairobi Stock Exchange. What a passive investor tries to do is to say, if the JSE goes up by 20%, their underlying investments will also go up by 20%. If it only goes up by 5%, similarly, that's what their exposure is going to be. So the goal is that the fund will simply reflect how the index performs. As a result, with passive investment, very little research is done on the underlying companies. And one of the great benefits of this is that the management fee is a lot lower. So you as the investor will pay a much lower fee than with active asset management we did a bit earlier. So it's particularly attractive because one, your costs are lower, and two, as we spoke about with active asset management, they charge higher costs, but frequently they fail to beat the index. So some of the intended benefits of passively managed funds is that we'll give an asset manager a specific mandate laying out the investment objectives and the target index. The asset manager will charge a fee for the service. However, this fee is generally a lot lower than actively managed funds. It's usually between 0.1% and 0.5%, whereas actively managed funds are usually between 1.5% and 5%. The idea with passive investment is that with a low-cost investment that tracks the index, more of your money will be put into investing on your behalf as opposed to being taken by way of fees by the asset manager themselves. So here's a Mac truth on passive investing. It's not perfect, but most individuals would be much better off in a low-cost, passively managed fund. Internationally, there's a massive trend towards passively managed funds. It's led by a company called Vanguard, and a lot more people are investing this way. So our advice to you is if you can get a very low-cost, passively managed fund, that's actually the most appropriate investment vehicle for more than 90% of retail investors.